Coming up in this week's Sunday analysis video, we're going to be talking about the indices. We'll take a look at gold, and we'll take a look, of course, at crypto as well, which has been all the rave this year, 2024, as we count down the days until 2025. I mean, we're getting really close here to the end of the year. As we get started, I do want to just ask a quick favor of you. If you enjoy my videos and you'd like to see more of them, make sure to subscribe to the channel and hit the thumbs up button as we get this video started. First of all, let's take a look at the S&P 500. I think this is an easy place to start, as it's pretty relevant to all sorts of traders. If you trade indices or commodities or currencies, the S&P 500 is one of my favorite risk-on versus risk-off gauges. We know that generally speaking, if the S&P 500 is rising, most risk assets like Bitcoin and tech stocks and things like that are likely to be doing okay. If the S&P 500 is collapsing, falling apart, then we might say the opposite is true. But right now, I would say we are still in a very solid overall, basically upward trend for risk assets. It's been a really, really good year for 2024. In fact, one of the most phenomenal stock market returns. Actually, I believe it's pretty close to being the best S&P 500 return for the century. And someone fact checked me on that, but I do believe it's pretty close. Point being, the last 2 years have been exceptional for stocks. And the question is, can that continue in 2025, or is it time for that show to end? Well, let's take a look at price action and see if we can get any ideas. So we had the big Fed day reaction, right? The big sell-off off of Powell basically saying we may not see many rate cuts next year. This one was a toss-up on as to whether or not they were going to cut rates this past week, which ultimately they did choose to, but his commentary was definitely what most would call a hawkish cut. And let's just take what that means by face value. A hawkish, right, cut. What does that mean? Hawkish just means that a central bank is looking to keep their interest rates restrictive on the economy, right? To try and keep inflation from rising too fast. Remember that an economy that's like going crazy actually can cause a lot of inflation, which can later crash an economy much harder. So hawkish basically means they're just being cautious. They don't want to cut interest rates too quickly because they see rising inflation risks. So they cut rates, but they basically said, this is the cut that we're going to give you. We might not get too many next year. That being said, let's take a closer look at price action to see how the market reacted. So this past week, you had a big steep sell-off in risk assets across the board. Bitcoin saw a big sell-off, the S&P, the NASDAQ, and we came all the way down to this key level of support. Now, I want to note that the November 5th election response from the market, where we saw this ginormous upswing in reaction to Trump winning the election, we saw this ginormous big push that continued for some time, and this is pulling back pretty hard. Now, noticeably, if we take a look at the Dow Jones as a indicator too, you can actually see that we pretty much completely erased all of the gains since the election. Now, the NASDAQ and the S&P 500, since that November 5th election, especially NASDAQ, they've held a lot of those gains, and I would say that that's still a good indicator that we're holding gains for now. That being said, volatility went crazy. And the question is this level of support going to hold? Well, I'll give you my take first, and I'll just be straight up because I know it can be kind of frustrating when you watch YouTubers and they don't actually give you their opinion straight up. My opinion, and this is, again, just what I'm doing. I'm not telling you what to do. I am looking to buy this dip. I like the risk to reward to stocks overall. I think equities do continue to be positive next year. And I'm definitely not in the contrarian crowd for saying that. That is kind of consensus. A lot of things look good. The economy looks solid. Employment in the U.S. is pretty strong. We have inflation much better than where it was a few years back. Fed still seems like the next move is to cut interest rates, which gives us a positive. The AI rally is continuing. I like stocks on dips at this moment. So I actually did buy the dip on Thursday, actually right as Wednesday closed. I ended up getting long the NASDAQ, and the market barely missed my stop loss, came back up, and I'm just slightly in the positive on this position. I do think that there is the potential for a Santa Claus rally in the stock market, which is basically this end of December period between this coming week and New Year's, where I do think that we could see risk assets continue to rise and float higher during this low volume week. Now, I could be dead wrong about that. And if so, I have a stop loss on my trade. I am not a, buy and hold forever kind of guy in terms of a lot of my trading positions. I do have things that I'll hold for the long term, but in terms of a trade, I have a stop loss on this NAS position. If the market rolls over and takes out those lows, I'm going to go ahead and get out of the way and potentially look for better pricing as we fall further. So I am a bull, but I'm going to be tactical with it and manage my risk appropriately in case we do see further downside. So I like the indices going into this week, and I wanted to also talk about Bitcoin, which actually showed up on the Edge Finder as one of our top setups for this coming week. Now, Bitcoin, you'll see NASDAQ is not on this list as a top setup, but it was when I took the trade. So it's since fallen off. But check this out. So Bitcoin, if we take a look, a bullish reading here on the Edge Finder, that's taking a look at the commitment of traders data, which takes a look, of course, at what institutional money is doing. They seem to be picking up a little bit of a bullish positioning on Bitcoin. Seasonally, it's a strong time for Bitcoin. The trend is to the upside overall for Bitcoin. GDP growth in the US is very solid. PMI numbers a little bit mixed between the two. Retail sales, great. That's especially good for Bitcoin. Seeing the state of the consumer being a little bit better than expected. I mean, take a look at discretionary stocks if you want to take a look at the state of the consumer. Discretionary stocks like Amazon, Tesla, those companies are doing quite well. And that is, again, a very positive thing for Bitcoin. That being said, I like the Bitcoin call. I'm going to be looking to stay in the current position that I have in Bitcoin. Of course, I'm recording this on Saturday, so by the time you see this Sunday morning, things may be looking a little bit different, but I do think that this has potential to continue to rally higher. A lot of people are trying to call for a top in Bitcoin, saying that the bull market is over, and in my opinion, I don't necessarily think that that is the case. I think that we have more room to go up on Bitcoin. That being said, as always, my opinion doesn't mean anything if the market decides it's time to sell off. And if that is the case, I will stop out and take a loss. And I will very transparently say on YouTube, look, I was wrong about something. It's happened on my channel many, many times over the years of doing this, as you can imagine. Markets are difficult to predict. And for me, we've got a nice upward trend. Again, momentum is definitely in favor of the bulls. We came back and tested just shy of this 50-period moving average. And basically, as long as we can kind of use that as a dynamic level of support and continue to hold those levels of support that I've drawn on the screen, I'll stay in the trade. So I like Bitcoin to the long side for now. We'll see how that plays out going into this coming week. By the way, the COT data was interesting for Bitcoin this week, and I'll pull it up for everything. They bought S&P 500. I thought this was really interesting. So they bought S&P, they bought the Russell. There was mixed response on the NASDAQ. Bitcoin, there was actually some buying that went on, right? So we saw more long contracts get added. Some short contracts get added, but more long. So notably a little bit more bullish there. In the gold department, they decreased longs and decreased shorts. Silver, they decreased longs, decreased shorts. US oil, they actually added quite a bit of long positions. So interesting accumulation of oil there. US dollar got real popular last week. There's no surprise there with the big, kind of hawkish Fed moment. The dollar got real strong. In fact, let's take a look at the dollar together just to see how things are going on that front. Again, dollar index, big pop here on the Wednesday meeting, then pulled back into the second or kind of the end of the week on that Friday. Wouldn't be surprised if the dollar stays supported around 107.5, but also would not be too shocked if we do see price come down and test that 106. But I remain overall bullish on the dollar, at least for now, until something changes in the economic data. U.S. economic data still looks very strong against its peers. This past week, we saw 3.1 GDP for U.S. on the final GDP number. That is a solid GDP growth compared to other places. Again, we can pull that up just for context. So if we go economic growth, for those of you who have the Edge Finder, economic growth, GDP growth, and we pull up the U.S., you can see there's that 3.1% compared to forecast at 2.8. Again, I don't see at this time a huge risk of recession. Corporate earnings are very solid. Again, I want to keep my eye on the ball here and stay risk on. That doesn't mean I'm going to be silly with my risk management. I'm still going to keep stop losses, still going to keep some cash on the sidelines. But again, the story here for risk assets to me still looks good going into 2025. And I do see things like Bitcoin and stocks going higher until you get some change in the weather, right? What I mean by that is change in the economic data. Those are going to be your first signs that something is changing. But again, we had PCE numbers that came in pretty good on Friday that helped to bounce back the market. Also had some dovish commentary from a major Fed official. So, you know, as long as inflation doesn't really start to uptick in the new year, I really still like the story for risk assets. Now, that being said, the dollar in a confusing way also looks strong to me relative to its peers, with U.S. economic growth so strong compared to other places. By the way, if you'd like to track economic data as well as retail sentiment, the commitment of traders data, the put-call ratio, investor sentiment surveys, we have built a pretty phenomenal tool at A1 Trading, if I say so myself. There's 10 people behind the A1 Trading company. And I do want to just mention that if you'd like to access our tools, we work night and day to build some of the best stuff for traders out there. If you want more insights on sentiment, economic data, seasonality, technicals, all sorts of stuff in a singular platform. Oh, and by the way, it's browser-based, which is super convenient. You can have it open. I mean, this is my analysis tab. These two tabs go with me everywhere I go. TradingView and Edge Finder. Get yourself a copy down below in the description. If you want to try it for 30 days, you can apply for a trial. Use that link, take 2 seconds to apply for it, and we'll get back to you as soon as we can to get you set up with a copy of the Edge Finder to try for 30 days. So take advantage of that link down below in the description. So again, the dollar index still looks real solid. Take a look at these charts here, and I've been talking about sentiment here quite a bit. If we take a look at retail sentiment, and I've been filtering here for major currency pairs, what you'll see here, and feel free to pause the video, contrarian bearish signals on things like Kiwi dollar, Aussie dollar, USD CHF, actually interesting dollar Swiss, but dollar CAD. Most currency pairs here, retail traders seem to be trying to call a top on the dollar's recent rally. I find that very interesting. So when we pull up charts like Euro dollar and Kiwi dollar and the Australian dollar, if they'll load, give me just a second. What you'll see with these charts is, again, some really strong one-directional moves. And you would imagine, oh, that must be retail chasing the move, right? It's actually the exact opposite. What we see here, night and day, there's clear data here, dollar CAD, everyone seems to be going short, loading the boat, trying to sell this thing as it continues to trend higher. And you might say, well, maybe it'll start turning tomorrow. Well, this has been saying this. If you've been watching the videos, if you're a regular tuning into these daily videos, you know that this has been going on for months now, right? We have seen as the dollar CAD continued to climb, retail traders are shorting this thing and just getting beat the heck out of. So again, I don't try and call tops in markets. To the best of my ability, you know, I consider myself a half decent trader after all this time studying this, but I still wouldn't call myself good enough to know when a market is going to stop trending one way. This thing could go on for much longer. We could go to 1.48 against the Canadian dollar. Who knows, right? The trend is your friend. That we were supposed to learn that on day one of trading. Somehow retail traders find a way to consistently mess it up and be on the wrong side of dominant uptrends or downtrends in the market. So again, having a simple tool like this by itself could really save you some time and money. So again, something to think about is just keep an eye on sentiment. Where is everybody, you know, trading, and make sure you're not just trading too much alongside the herd. It's okay to be in the same direction as the crowd sometimes, as long as you have your own good reasons for doing so. Put call ratio is another one I've been watching quite a bit. We saw the put call ratio actually spike into fear territory in the second half of the week following the big Fed announcement. People got scared, went from really, really bullish in the market to a little bit bearish, people getting nervous, buying protections. What is this telling you? The put call ratio shows you the volume of puts versus calls. And so when you get this big spike up, like we saw around the election and like we saw this past week, that's telling you that a lot of volume is going into the put side. People are buying puts or protection in the market. They're making bearish bets. And that to me was actually a good signal. That's why I went long a whole bunch of stuff throughout this past week. I'll show you some of the current positions that I have. I actually went long the semiconductor ETF SMH, sitting at support level here. We'll see if this can hold. I do like the trade here as well. Bit of a contrarian play. I also have a position on TLT, looking a bit extended to my opinion, in my opinion. And what I did here is I actually sold a cash secured put on TLT. So if the market continues to go lower, then what that would mean is that my put that I sold would be a losing position to a degree, but really what that would just mean is I need to buy the shares. If you're unfamiliar with selling cash secured puts, I encourage you to check out my video on them. If you look up Trader Nick options strategy, you can take a look at that. But I sold puts in this area, basically thinking that I could see a bounce here for TLT coming, and maybe I'm a little early. Again, I mentioned I don't like to call tops and bottoms, except when I'm using some sort of dollar cost averaging approach where I'm trading based on the fundamentals. I don't necessarily think this is the immediate bottom and that we're going to rip higher, but a bottom could form here. And if it doesn't, then look, I could actually accumulate lower prices and build a dollar cost averaging approach. I use two types of trading strategies. One is a momentum or trend following strategy, and where I'm using a trailing stop and I'm using momentum and I'm trying to trade quickly in the direction of the trend. Or there's these types of strategies where I dollar cost average using a combination of selling cash secured puts or covered calls, aka the wheel strategy. So looking to play TLT here, as I do think it's a little bit overextended. I do still think that we could see some rate cuts coming in next year, and if rate cuts do start to happen, TLT should actually see a bit of a bounce back the other direction. That being said, again, I also have some other positions. I got to talk a little bit about everything. XLV, another contrarian play here. XLV is the healthcare sector, which has been absolutely pummeled here recently because people fearful about what Donald Trump may do, his administration may do to the healthcare world. In my opinion, I think this is a little overblown. These are great companies overall. The basket of them mostly make great money. They're a big component of the S&P 500, and I don't mind owning some healthcare for the longer term, especially after what has been from peak to trough here. We're looking at about a 14% drop in healthcare names. Sold a put right at 138, so if the market continues to go lower, I still have to buy the shares at 138, and if the market bounces back, I pocket the full premium. In both cases, I get paid to write the bet, and if this is not making sense to you or sounds too confusing, don't worry. Options are a little confusing on the surface, but they don't have to be. Like I said, you can search up my options trading strategy video on YouTube if you'd like. But long story short, I am bullish XLV and looking to dollar cost average. That's the easiest way I can explain it. Let's take a look at gold here. Gold, if we take a look at the price action here recently, a nice bounce back on Friday following the better than anticipated PCE numbers. Again, nice little bounce back. Inflation was a bit cooler, and gold loves cooling inflation. What it does not like so much recently is interest rates potentially staying where they are and inflation not moving too much. Gold rallied most of this year off of the back of cooling inflation and economic and political uncertainty. And then we sort of saw the election come and go, no big scare there. And then, like I said, the economy looking pretty solid and Fed not really signaling too many rate cuts has made gold less attractive. For me, on the bullish side for gold, I'd need to see, again, more signs that rate cuts are actually coming. Inflation is actually going to continue to cool, in which case I can look to get back in on the momentum side of trading gold. That being said, I do have a longer term position that I'm playing. GDX, again, another sell put position, looking a bit extended here for me. So looking to potentially build a position on the gold miners ETF. Now, again, we'll see how that one plays out. Offers quite high premium as it is a pretty volatile instrument overall. Take a quick look at the Russell as well. Big sell-off in the Russell. Small caps getting absolutely beat up off the idea that less rate cuts are coming. Makes a lot of sense. But to be honest, like I said, I think we could be surprised, could see some rate cuts next year. So if the Russell continues to move lower, I will look for some opportunities to potentially build some longer term buys in the Russell. So here's a look at that VIX that I mentioned. Again, big pop in volatility here past week, and then immediately faded back down off of the better than expected PCE numbers. So real interesting stuff happening. This past week was very, very eventful. And again, keeping an eye on things like the put call ratio made it so much more clear what was going on this past week. Again, one of my favorite indicators in the world is the put call ratio. And sneak peek, guys, check this out. So we have the put call ratio going on for SPX, but guess what's coming? I just worked with the dev team this past week to get a project started. We are going to get gold and oil and we're going to get the NAS in here. We're going to get you guys put call ratios for everything. So we can actually look at put volume for things like the ETF GLD, which is a gold ETF. That's coming. So if you already have the Edge Finder, then Merry Christmas. That is going to be so much fun. It's one of the most fun indicators to me. I love looking at the put call ratio, and to be able to select like S&P or gold, Dow Jones, all of that, man, I am so pumped for that and can't wait to share that with you guys who are our software subscribers. If you don't already have a copy of the Edge Finder, like I said, take advantage. We're also doing holiday discounts right now. If you made it to the end of the video, make sure use the promo codes that are in the description. Get yourself a copy of the Edge Finder, especially if you have some extra time around the holidays to play around with it. Also, here's some free stuff for you. In the description, if you're looking for a new brokerage or you're looking to join our Telegram channel, explore the description. There's plenty of free stuff for you. You'll also be supporting the channel if you choose to do it. But in the process of doing so, you get yourself some free stuff and sign-up bonuses. There's some sign-up bonuses down below with some of the brokers that are linked there. And all of the brokers linked in the description, you can trade directly on TradingView, which is super convenient. So again, use those specific links. You'll be supporting my channel and you'll get some special sign up perks when you do so in the description below. Thanks, guys. Have a great week ahead.